Has Box, the cloud-based enterprise storage provider and mobile business collaboration platform, finally found its groove? For most of the time since its IPO a little more than 2 years ago, Box has had it rough, with the stock plummeting in 2015 and then flatlining for the first half of last year. But just since the beginning of 2017, Box has run up an astounding 20%. So is this the first inning of a longer-term rally, or have we missed the move? Box reported after the close yesterday, and my overall impression was mixed to positive. On the one hand, the company delivered a top and bottom line beat. Its free cash flow came in positive for the first time, and its billings, the key metric in this business, increased by 22%. On the other hand, Box's earnings guidance for both the next quarter and the full 2018 fiscal year, which has already started for them, was lighter than some analysts were looking for. However, the reasons for that earnings weakness is because the company plans to spend more money to invest in its future growth, something we don't normally punish fast-growing tech stocks for. Now, the stock got slammed today, sinking a little more than 8%, but I have to wonder if the market's misjudging this one. Let's take a closer look with Aaron Levie. We got to learn more about the quarter, where the company's headed. Mr. Levie, welcome back to Mad Money.
Hey, thanks, Jim.
All right, so, Aaron, you laid it out very early on. You said, listen, your goal was to be free cash flow positive. It has happened. Please tell our viewers why that is an important milestone.
Yeah, so this is a massive milestone for our business. 2 years ago, when we filed to go public, we told the world that we would be free cash flow positive in Q4 of FY17. That was the quarter that we just announced, and we achieved that milestone, generating $10 million in free cash flow. So the investments that we had laid the foundation for in terms of our sales, our marketing, our technology foundation over the past few years have paid off and allowed us to reach the scale that we're now at, where we generated nearly $400 million in revenue last year, closing the Q4 with $110 million in revenue. So now that we're cash flow positive, we can reinvest those dollars back into growth. We're going to remain free cash flow positive coming into FY18 for the full year, with some seasonality on a per quarter basis, and we're going to be able to drive the business to grow, quite well this year, where we have pegged our guidance at $500 to $504 million in top line revenue for this coming year, so $500 million in revenue.
Well, what's next? I mean, should we start thinking about the value of your booked business and off-balance sheet booked business so that we can get a sense that maybe there's cash building and your stock's too cheap?
Well, I think that on the cash side, we ended the quarter with $200 million, over $200 million in cash in the bank. We obviously don't have to raise more capital from the outside world now that we'll be free cash flow positive on an annual basis. And we're going to be driving more growth into the larger enterprise segments that we've been serving so successfully over the past few years. So in the past quarter, we did 64 deals over $100,000, which represents sort of the threshold where we start to think about these as larger enterprise customers. We're seeing more and more growth within the large enterprise segment. We had multiple customers that did multi-million-dollar transactions with us that are standardizing the way they manage their content and their collaboration and their data on Box. So our strategy of being the cloud content management platform is really paying off in the enterprise today.
I thought that there was a great moment in the conference call where you said one great example this past quarter is we did a large transaction, a seven-figure transaction with a financial services firm that replaced documents, is the process of replacing documents as well as using Box to solve all their end-user file sharing collaboration. If I went to that place, in other words, everything that they had, where they had big boxes, and now it's on file somewhere?
Well, it used to be in their data center, and what they're trying to do is migrate all of the infrastructure and the document management software technology to the cloud. And when you look at a large, in this case, a financial services firm that needs to be able to have the security, compliance, robustness of a platform that can scale to all of their employees, when they need to be able to have all of those capabilities in one solution, Box is the only platform that can do that for them. So they're able to both retire legacy infrastructure and spend, as well as solve all of the net new problems that their end users have around sharing and collaborating in the cloud with Box.
Now, you've been very clear with me on our show exactly what you felt would be the progression, but I think at the beginning it was difficult because I think people wanted to force you into looking like another company or making some promises that you were not able to keep, not that you ever wanted to make them to begin with. You put out a very nice note warning the people at Snap that perhaps they should not be trapped by what others think, but make a clear strategy and stick by it. Why'd you put that out?
Well, I think that was just in one of the interviews that we were doing around their IPO, but due to our earnings being at the same time, But in our case, what we learned was having a very predictable business model where you were able to drive consistent growth and you over-communicate your strategy. We were not well understood going back 2 or 3 years ago. We were seen as a way that enterprises could store or share their files when we were building out a very differentiated platform to help companies manage and secure all of their corporate documents and their data. And so my note or message to Snap was certainly make sure that you drive predictable, consistent growth and you over-communicate what makes you different. And then ultimately Wall Street will really understand the story.
I just want to cross-pollinate for a second. We mentioned Snap. Last night we had a guy from Viva on, very good company, Viva, and a lot of his clients are exactly the same as your clients in the life sciences. Do you guys integrate? How does that work?
We do see each other within the life sciences space. We're obviously focused on more horizontal use cases,
right,
which to us means we want to solve everything from how the R&D team collaborates to the sales and marketing teams share their content to how the finance team works with their external auditors. So we are in many large life sciences companies, organizations like Eli Lilly, Allergan, Amgen, Pfizer, and many others. And in some of those environments, those customers are using Viva for a number of very important use cases. So we see ourselves as a part of a broader industry trend where enterprises in every industry are going to leverage best-of-breed platforms for different parts of their technology stack. And so we do tend to see them, Microsoft, Salesforce, and many others within our customers.
Good, because I always want our viewers to understand that there's these ecosystems. You're part of them. You're a very important part of them, and that way it helps them understand it better. Aaron Levie, co-founder, chairman, CEO of Box. Congratulations on being cash flow positive in time, just as you predicted. Mad Money is back after the break. Booyah! Jim Cramer here from Mad Money. Thanks for watching CNBC on YouTube. Click here to subscribe and get the jump on my exclusives with CEOs, plus market news, investing advice, and a whole lot more.